Is that really going to be a market mover, or are we still blindsided by a pretty weak lead on earnings from the US?
I think we're going to be following through from that lead from the US. In fact, the US market was up by 0.7% at one point during the session before ending down by 0.8%. So initially, there had been optimism around that positive lead coming out of Europe, and also news that the Eurozone finance ministers had agreed to release 30 billion euros by the end of July to Spanish banks directly, and also given the Spanish government more time to meet deficit targets. But of course, by the time the US session had started, the market once again sceptical that this was enough, and we did see a negative session in terms of the US and a sell-off in risk. In the US, it was the industrial and the materials sectors which really led the decline, so we are expecting to see weakness in those areas in Australia today. And if we do have a look at how commodity prices traded, we saw oil prices down by 2.4%, copper prices were down by 1%, while Rio and BHP gained in London up by about 0.2%. By the time the US session finished, we saw them making losses, with BHP's ADRs down by 2.2%. Alcoa also during the US session down by 4.1%, but that's probably already been factored into Alcoa shares, which fell 6.6%. So all up, it does look like another weak session on the Aussie share market. Last night was the fourth consecutive session of losses for the US market, which is the longest losing streak that we've seen in around about 2 months.
Their answer on, the reason to be in equities, Julia Lee, even Keir Nelson saying, look, defensives are hurting, let alone some of those more, high risk sectors of the market.
Defensives are actually doing very well. If we have a look at Telstra, including the dividends, the franking credits, over the last year we've seen a gain of 34% in Telstra shares. And if we have a look at some of the stocks that have been reaching 52-week highs, these are all defensive companies, stocks like Credit Corp. We've seen Telstra Corporation, Coca-Cola Amatil in the last month has reached an all-time record high. So certainly a lot of demand for some of those high-yielding defensive companies out there on the market. But the area which is suffering are the cyclical areas. And if we have a look at the case of being in equities at the moment, it is because valuations are low. We're seeing the lowest valuations in 2012 so far. Balance sheets are in much better shape. And while we are looking for possible capital raisings coming through from some of the miners with this quarterly production reporting season to boost up their cash levels and strengthen balance sheets, really it makes more sense for merger and acquisition activity at this point, because we are seeing much stronger balance sheets. Corporates have a lot more cash on their books and valuations are relatively low. There isn't confidence though. Europe really overshadowing any sort of fundamentals, and that's really what we're seeing on the market, the macro picture really dominating market sentiment and market performance. So it does look like another weak day on the market based off what we've seen offshore. But I guess once we do see a turn in the cycle, we're going to see a pretty quick movement. And if we have a look at that wealth management space, we are around a low in the cycle, which makes it an attractive time to start accumulating some of these wealth managers. But of course, all wealth managers aren't built the same, and unfortunately, Platinum Asset Management have had some lackluster earnings. It's a difficult environment to be a stock picker in when all assets seem to be moving in correlation together. So it is a difficult environment for Platinum Asset Management, but you only have to look at money managers such as IOOF, which have been doing quite well in this environment. So I guess in this type of environment, it's time to pick up quality, because we are seeing most of the market discounted.
6% at the moment. Do you expect them to be weighed down more than that if we're talking about capital raising? Or, to what extent has it already been factored in, as Peter's just talking about?
Look, often the speculation around capital raising is more damaging than an actual capital raising itself. If we have a look at Seven West Media shares, we've seen the shares today reaching another 52-week low. In fact, shares trading at the lowest level we've seen since 1992. A lot of that has to do with speculation around a possible capital raising. Those CBA analysts coming out and predicting a $400 to $500 million capital raising by the company. And that's on top of Citi's analysts, media analysts call last month calling for Seven West Media to do a capital raising as well. So unfortunately, this is a cloud over the share price. Of course, back in April, we did see Seven West Media come coming out with a profit downgrade. It is predicting EBIT of $260 to $270 million for the current financial year. But of course, we have seen softening advertising conditions, and this is a key because we have seen conditions worsening. What we probably are going to see is FY13 earnings coming under a fair bit of pressure, and that really raises the bar in terms of balance sheet strength. Now, Seven West Media aren't actually clear on their banking covenants, but if we just take an average for the market, it's around about 4 times EBITDA to debt. And so in that kind of scenario, if we do see a fall from FY12 earnings, then Seven West Media's balance sheet is looking quite vulnerable. So speculation around the capital raising, unfortunately not good news for share prices. We're seeing shares trading at the lowest level since around about 1992.
Brief thought on ERA, still with you, Julia. Production reports coming out for June quarter. What are some of the, I suppose, guidance issues you'll be looking at?
We've just seen the production report dropping on the market. So ERA coming out with its second quarter production numbers. Now, ERA is a uranium producer and also it's owned 68% by Rio Tinto. And what we've seen in the short term are uranium prices coming under a lot of pressure because of the softness in demand from Japan. But longer term, that demand is expected to be boosted by China. So if we have a look at the second quarter numbers, no real surprises here. 632 tonnes. That's up 3% from the previous quarter and up more than 600% year on year. And that's because in the previous year we saw rain being a huge factor in terms of production and really having major consequences for production from January to around about July in the previous year. So the fact that we have seen a kind of wet season has been good news for ERA. But the key for ERA shares comes from a new mining lease. The current lease with its traditional owners only really covers up to 2021. So we are expecting to see a new mining lease, and that would help to underpin the Ranger 3 underground project as well. So that's going to be a key catalyst for the stock, and that's one thing that the market's watching very much for. But I guess the second quarter production numbers really helped along by that kind of wet season that we've seen.